Welcome to the Traders Clinic, your regular shot in the arm of trader insights, philosophy and knowledge, brought to you by two professional money managers, Ali Crooks and Charlie Burton.
In each episode, we cover all things from the world of trading, as well as answer your burning trading questions.
We do indeed.
We do, mate.
And what are those?
Well, we'll come to the questions in a moment, but we have a topic here called the costs of trading. Now, we're not talking about the actual costs that you get on a trade. I think we're taking it the bigger picture here, the different costs, emotional costs, time, energy, input that a trader goes through along their journey to getting successful and becoming successful.
Well, yeah, no, that's true. I was going to go with the actual cost, but but I think that one thing when it comes to costs, you'll talk about like you said, the emotional costs in a moment, but there has to be. It's a business at the end of the day. So like in any business, there has to be costs. Lighting, electricity, whatever it might be, there are costs if you run a business. And trading is one of the lowest barriers from a cost perspective to getting into it that there is. And yet people don't want to accept some of those costs. So I'll go down that route, and you go down the emotion.
I think it's good.
So, for example, you'll get people go to brokers who might be offering the tightest spreads, and they don't realise that sometimes the brokers that are offering you the very tightest spreads, unless it's an institutional sort of level, looking at professional clients, but retail brokers who are making out that they're having, and there's been examples of retail brokers, for example, who have offered like zero spreads in the past, and we've come across those, just because they're offering tighter spreads doesn't mean to say you're getting good execution. So just because it sounds good, that doesn't necessarily mean that it's going to be the best deal. If they're offering you the tightest spreads, you've got to ask yourself, well, how much of how are those brokers actually making their money? We deal with some really good brokers here, and Tickmill are one of them, and it's that balance between, from a cost perspective, of having competitive things like competitive spreads or and swap fees as well, overnight charges. But if it sounds too good to be true, then they're probably up to something else in order to recoup some money, which might be poor execution, for example. So that was where I was going to come from a cost of trading perspective, and I think that. We hear this a lot. You get people who go down the day trading route, and they're like, "Oh, I'm not going to hold my trades overnight because the costs." And you get this nonsense that they think that you get these overnight charges, but they really are quite small. They will add up over time, but you really it depends on the markets you're trading. But if you're trading highly liquid markets, like let's say euro dollar as an example, you can be paying an overnight swap fee and still hold on to a position for a month, 2 months, quite comfortably. Yes, It's going to build up, and it's just a cost of doing business, but it's still only a percentage of your total profit. But people seem to think, oh no, I can't possibly do that because there's going to be these charges for holding an S&P position or whatever it might be. And you think that's just the cost of doing business.
It's like the old saying, isn't it? Looking at the cost of a shovel when you're digging for gold. Without the risk of sounding like back in my day when I started out, and it was down the coal mines and that old vibe. But I would have placed, and you would have placed trades on dial-up, and you were paying the same equivalent, probably more out of the amount that you would pay now for internet access.
Yeah.
And I'm not going to sit here and say, oh, we had it so much harder in our day, but I can remember partial fills. I can remember placing a trade and it saying partial fill, and then you're sat there for 3 or 4 minutes waiting to see if the other part would. And that was just the norm. So I look at the landscape now and think how great it is for the new trader coming in, but they've got no frame of reference. But it was, even back then, there was still this mindset of, well, they're charging me for this. And I'm like, well, good, because you want your broker to make money. You don't want them to be taking the mickey, and it is a balance between, like you said, the size of spreads versus what they charge. But slippage, people are shocked that they've had one trade in 50 that slipped them by a point, and I'm like, this is just the cost of doing business. And I think I think what you're saying by default, which is this idea, is if you treat it and see it as a business, you wouldn't look at any other business and expect to have a cost-free mechanism to make money. And I remind traders over and over again that this is an industry where if you were to perform at the same level, so let's use an example of 30% a year, and you did 30% a year in, year out for the next 10 years, you are going to be earning more money in years 7, 8, 9, and 10 than you are in the first year. Any other industry, if you're a salesperson and you hit your sales targets, the chances are next year they're going to put your sales targets up. And then the year after that and the year after that. So you have this wonderful opportunity. Yes, only a certain percentage of people are ever consistent over the long term, but you have this wonderful opportunity. Yet some people almost expect it to be cost-free. And I think worrying about rollover charges, again, you can't control it. So yes, different brokers will offer different ones, but it's an acceptance that there is going to be a cost to do business in terms of the actual monies. Yeah, no, absolutely. I don't know if you want to talk about the other emotional costs, but the emotional costs are far greater. Yeah, I mean, really? There's probably a whole nother episode, and I think linking it to what we've said is if you are in a place of frustration because you think your spreads widen a little bit before the markets close, or you're making a decision to day trade because you don't want to hold trades overnight. Well, what if the cost of day trading is too much? You're mentally not in a place to do that. You unknowingly are randomly trading for 3 hours on a Tuesday, 2 hours on a Wednesday, different times. And actually, what you're actually doing is not giving yourself a chance to be successful. But the reason you're doing that is because you don't want to pay for overnight charges. Then actually what you're doing is it's a greater cost over here, both in terms of your success, but also your emotions. So I think the idea of penny pinching when it comes to trading is very, very risky, because as I've said, you want your broker to be in a position where it does make money, because then it's running its business effectively. And so there's a huge emotional cost to trading, and it's I think to look at the two things in parallel, an acceptance that you're going to pay fees, you're going to have certain spreads, you're going to have certain payments, physical costs. Looking at it from the same place from a trading point, in acceptance that it is going to be emotionally challenging. We've talked about this a lot in other episodes, but if you go in with this idea that we'll get to this point in this point in time where I don't get emotionally challenged by my trading, then you're setting yourself up for failure. So yes, there's a huge amount of emotional cost, but I think if you can go into it with that acceptance and see it as a challenge rather than something you need to run away from, then those costs are easier to pay from an emotional point of view. Yeah, good points. I won't add to those. Let's we'll move on. Yeah. So we have, this is interesting because you could argue this links in very well. How do I stop feeling genuinely concerned if my strategy goes through a losing period? How do I stop myself? Oh God. Okay. So there are so many things that we can look at. One is that person should have addressed that before they even went into a losing period. So again, time after time after time, it comes back down to mindset. So you have to be working on your mindset even when things are going well for you. So even when you're in a nice period where you're generally got your equity curves moving higher or whatever, you've got to be working on your mindset for the next pullback. So that if you're accepting that at some point you're going to have a drawdown, when it does inevitably happen, because it will happen, every trader has, in order to have an equity curve, there has to be peaks and troughs. So you're going to have a peak equity, then you're going to have a pullback, and that pullback is a drawdown, and to varying degrees. So you don't wait for the drawdown to happen in order to then say, how do I cope with this? So how do I stop? How do I stop feeling generally concerned? Yeah. Well, it's too late in a way. You should be pre-preparing. However, we're here to give some advice. And so, okay, so you're at that point. So what are some of the things that you can do to alleviate those concerns? Right. One is to go back potentially over your historical data if you record that. And let's be brutally honest here, greater than 50% of people don't. Yeah. So we can't just say,
go back over we can say that because people should log their trades and try and encourage people to log their trades more. But we know that not everyone's going to have that data to go back over. And not everybody trades mechanical. I don't trade mechanically. I have strategies that I use to enter the market, but I don't like mechanical trading. And a lot of people out there don't like mechanical trading.
Exactly.
So we can't say back test your strategy because not everyone trades in a mechanical way like that. They're using a combination of things. So again, from a mindset perspective, how do you stop the feeling of,
how do you stop feeling genuinely concerned?
Okay. So some of the things that you can do is say, again, we've covered this sort of stuff off a lot over the past. Look, it's just this at the moment. Yes, you're going for a cluster of of trades which are generally creating a pullback in your equity, but is it within historical norms? Now, it may not be, because you may not. I'm trying to go the other way, away from someone who's mechanical trading with a strategy, because not everyone does. But you can still say, well, actually, is it me? Is it my approach? Or is it just the market? Because a lot of the time, you can scroll back the charts even and just look at your approach and say, yeah, there's been plenty of times historically where my approach would not have worked in this market. So that's one way of doing it. You can also use the Mark Douglas approach of saying, look, this is just one trade in the next 100 or 1,000 trades. All right, it already is more than that because you're into a drawdown, but is it normal? Would it be normal to expect, with what's going on with my performance right now, that should happen? So is it me just reacting to it and feeling this way? Or is it, if I was looking at this as a third party, would I say there was anything potentially wrong? Well, no, not necessarily. So how do you stop yourself? Take that step back to stop yourself feeling concerned and say, okay, if I was coming at this logically and I was looking at all of this, if I did have the data, then the data would tell me, and I'm sure you'll go down that route. But also, I have to accept that this sort of thing, drawdowns are going to happen. And I should have prepared for it before, but I'm in this situation right now. Well, statistically, if I take 1,000 trades or 2,000 trades, surely I should accept going through a drawdown. So try to desensitize how you feel towards the situation you're in, because you're just going through fight or flight responses right now. Is that rational? Probably no.
Like that a lot. I'm actually going to go at it from a risk point of view, because we don't know this person's strategy, their risk management, what they're doing.
Yeah.
But I've worked with traders in the past. I remember a lady, I was like, she really can't get past the moment. She's in the moment. She's constantly worrying about every trade she's in. We had every drawdown she goes through. Then she bottles the trades on the back end of it, just at the point she needs to be, sticking to what she's doing. And I never thought to ask her during about a period of 3 months, because I just assumed. And I said, what are you risking per trade? And she said 4%. And then I was like, well, of course you're going to be genuinely concerned about every drawdown, or you're going to be overly focusing on the trade because you're risking far too much. And she thought she was being prudent because she'd come from a share background where you just buy your shares. So that would be something I would say to him, is just check in. We have no idea what you are risking, but even if you are risking 1%, if you're struggling, maybe you need a period where you risk 0.5% just to desensitize yourself, like you said. So look at your risk, because there's a lot of traders that think they're being sensible in their risk management and they're actually risking far too much. So a drawdown would create genuine concern. And I remember saying to her, I said, well, if I was risking 4% and I'd had 6 losing trades, I would be genuinely concerned.
Yeah.
So, and I've been doing this, at the time, 15 plus years. So look at your risk as well, because you might think you're being prudent, but you might be actually overexposing yourself.
On that note of that subject of risk, I think a lot of people think 1%. There's this whole 1% rule, and we use it a reason why, just because it's easy to talk about 1%. But there's a lot of traders out there who will trade at 0.1 or 0.2 of 1% risk per trade. People think, and this is the thing, like you said, there's a lot of people who end up trading at 1.5% risk per trade. Not necessarily 4, but 1.5. And it's the same story. And you're like, why are you so, emotional towards your trading. Oh, well, you're trading at 1.5%, or even at 1%. Just because of 1% risk to one individual
Exactly.
might be easy. To another individual, that's just way too much. I know traders, I've got traders who they trade 0.3 of 1% on all of their trades. They won't go that's their max risk per trade. So I think that people feel that they should trade at 1%, and it's just not true. Different traders are going to trade differently. And this is why when it comes, people say, when they ask, how much percentage return do you make a year? Well, that depends. It's irrelevant really, because it depends on how much you're risking per trade. So if you've got one trader, for me on my pension money, for example, it's at that low end of risk, way, way, way under 1% risk. So if I say to someone, I might, on that, I might make 15 or 20%. They're like, really? Is that all? Yeah, I know, but it's the risk adjusted return. They're not realizing you're risking so little, or such a small amount in order to make those gains. But yeah, 100%. People need to risk less percent.
And on that bombshell, he's Charlie Burton.
And he's Ali Crooks.
Trade safely out there.